So if you didn't finish in the class time, did you do it by yourself after that? Okay, I hope you did. So according to some students' requests, I'm going to go over the direct material cost budgets, right, later when we start. So today's plan is that we are going to finish talking about the financial budgets. And the emphasis is on the cash budget and the statement and the budgeting statement of cash flow. So these two are the emphasis here. So I was on the call with a lady from the AICPA. So she was talking about how important nowadays for students to have Excel skills as well as other software skills, because she was talking to some big four firms, right? You know big four firms, right? KPMG, Deloitte, EY, and what else? What did I miss? Yeah, PwC, right? So they found out that the students that they hire lack Excel skills as well as other skills. So they are talking about what's missing in the current curriculum, right? So I'm happy that I'm teaching you guys about this kind of skill, right? So that you will learn this kind of skill from early on, right? So that you won't have this kind of shock when you go to the job market, right? But the things that I teach here are all the basics, right? So, but it will give you an idea of how you are going to perform your work in reality or close to reality, right? So we, I think we are on the right track. Last time we already went over the operating budgets, right? So let me just emphasize some important points here, right? So when we start to make the master budgets, right, the key element is the sales budget, right? And the reason is that the following budgets are based on the sales budget, because once we decide the expected sales amount, right, we can decide the expected production amount. And also we can decide how many materials, labors, and overhead we need to use for the production. And once we know the expected sales amount, we can decide the expected S&A expenses. So the sales budget is the key element or the starting point of the master budget. And for the second type of master budget, capital expenditure budget, we are going to skip that. If you are interested in that topic, you can read chapter 26, right? But I don't think you are interested, so let's forget about it. And so today we are going to cover the financial budgets. So financial budgets basically is that we are going to create the expectation for the financial reports, right? So we have the balance statement, income statement, and the statement of cash flows. And our emphasis here is the statement of cash flows, and we're going to talk about the budget for the cash. Okay, so let's start with the cash budget. So when it comes to the cash budget, we talk about the cash inflow and cash outflow. Okay, so the first aspect, cash inflow, we also call it cash receipts, right? Basically, it means that we receive cash from multiple sources. But one of the major sources of the cash receipts for firm, especially for firm, should be the revenue, right? Let's say I am a manufacturer, right? And I sell the products that I make to the wholesalers, let's say. So one major component of this cash inflow or cash receipts is the cash or cash equivalents that received from my customers, right? So the first element that we're going to look at for the cash receipts is the cash that we collect from the customers. Okay, so the cash, I think because I don't know why the table looks like this, but this is a table listing the expected revenue from the sales budget. So basically, the cash that we expect to collect from the customers is from the revenue we gain from them, right? So when we make the cash receipts, we depend our estimation on the sales budget. Does that make sense? Right? Because we sell the products to the customer, right? And maybe we bill them on some accounts receivable, right? And sometimes, and then we collect cash or cash equivalents from them, right? So the source of the cash receipts is from the expected sales, right? So here, this table is from the sales budgets that we made from last time. And you can go back and validate the numbers here. So let's say the firm says that when we bill the customer, right? So all those, okay. So the rule is that, so let's say in January, the expected revenue is 80,000. And from the past experience, usually we can collect 75% of the sales revenue, which is in accounts receivable when the transaction was made. Okay, we can collect 75 of them in the month of sale. Okay, what does it mean? Right, it means that, let's say in January, if we sell 80,000, right, we can collect 75% of the 80,000 in cash in January. Okay, so this is what it means by this. Okay, and then 24% of them will be collected for the next month. So it means that, okay, so in January, right, we can collect 80% of January's revenue in cash, right? And the rest 75%, and the rest 24% of January's revenue will be collected in cash in February. And this is the practice for them. Okay, but we are going to have 1% of the revenue estimated as bad debt. Okay, so what does this bad debt mean? It means that we cannot collect them, right? So they are gone. It means that the customers sometimes they just don't pay you, right, for multiple reasons. So let's say this is the practice. No, this is the rule, right? The manager gives us, and we're going to use this rule to come up with the expected cash receipts from the operation. Okay? And we also have some extra information here. So we know that at the end of previous year, I should change the year here, but the previous year, on December, we have a revenue of 90,000. So based on this information, we want to come up with the expectation for the cash receipts for the next quarter. So let's see how we can make it. Okay, so the cash receipts is summarized in this table. Okay, let me explain what this table means. So the first column, cash receipts, just summarizes the two sources of the cash receipts for each month. So basically, in each month, right, we can collect cash from the revenue of this month as well as the revenue from the previous month, right? Because according to this sentence, right, we can collect 75 of the accounts receivable in this month, and 24% will be paid in next month, right? So it means that for each month, we have two sources of the cash, right? The first part is the 75% of this month's revenue, and 24% of last period's revenue, right? Does it make sense? Right. So here the second row and the third row is basically summarizing the two sources, right? The part that's from the previous month and the part that's from the current month. Okay? And then, so for January, February, March. So let's see how we make this estimate. Okay? So for January, so what is the month before January? It is December, right? December of the previous year, right? And in January, according to the business practice, right, we can collect 24% of the previous month's revenue as cash in January, right? So here, in January, we are going to collect 24% of December's revenue, which is 90,000, as given in this sentence, right? The sentence says that on December of previous year, we have revenue of 90,000, right? So it means that 24% of the 90,000 can be collected as cash in January, right? Does this make sense to you?
Yes.
Okay. So, and in January, we can collect 75% of January's revenue as cash, right? So the second component of the cash receipt is the 75% of January's expected revenue, which is 80,000. Right, so this is the second component. So in total, in January, we expect to receive $81,600. Right? Okay. So following this logic, can you please calculate the different components of cash receipts in February and March, and come up with the total cash receipts for February and March. Okay, now it's your turn to do the work. And later we are going to practice on Excel, right?
Can you go back for the February data?
February data? Okay.
Can you go back?
You want this?
Oh, yes, yes.
So following this business rule, right? And also for this sentence, it doesn't mean that in real practice it's the case, right? So this is just one example of how things are running in the practice. So each month you collect cash from two sources. One is from the 75% of this month's revenue and 24% from previous month's revenue. Right? So just follow this rule and then come up with the expected cash receipts for each month.
Okay, that's good.
So did you guys take this down so that I can? Yeah. So did you come up with the cash receipts for February?
19,000.
Is that the total number? How did you come up with that? So can you please tell us the components for different, for the prior year and the current year? So let's say for February, right, you collect cash from both February and January, right? So what is the amount that you collect in February that is from January? This is confusing, but I want to have the number for this box. Is this what you got? Alright, so basically in February, right? The cash you receive. Do you understand your neighbor? Yeah, could you please explain this?
I know how to get, I just don't know how to get,
You don't know how
where
to
the
get
number from February comes from.
the number from February.
Yeah.
Okay, so it's from the first slide, this slide. And this number is actually taken from the sales budget that we did in last class.
So you do 96,000 times what, 0.24?
So are you talking about this box or this box?
The top.
On the top?
Yeah.
Okay. So the top box means that the cash that we receive in February from the revenue of the prior month. Right? So the prior month of February is January. Right? So it means that, okay. So we need to use the January's revenue multiplied by the 24%. Right? If you think about it, right? So it means that, let's say I owe David 80,000 in January, right? And I pay him 70% in January, and I pay him the rest 24% in February. So this is how this works. And then in February, we are going to collect 75% of February's revenue. Right? So here, the second component, right, is the 90,000 multiplied by 70%, and the 96,000 is February's expected revenue. Right? So if we take the sum, and Johan was right? So the total amount is correct. What about March? Jess? Jess? Wellington?
I can do it, but we'll get 96,000 times 24.
Yeah. So the first component is the 24% of February's revenue, right? So it's 96,000 multiplied by 24%. Yeah.
And then, can you go back to like the first one?
It's fine. I will just give you the number, right? So it's 120,000 revenue for March, right? So we collect 75% of them, right? So the total is this one. Okay. Did you get it? Mary, did you get it? You? Okay. So this is how we come up with the expected cash receipts, right? Based on the business practice given by the managers, right? So if you understand the story behind it, you should be fine with the numbers. Right? So this is the cash receipts. Now we expect, so this is our expectation that in each month, this is how much we expect to receive in terms of cash, right? So this is the first component of the cash, right? This is the inflow. And now we look at the outflow. So when we have cash outflow, right, it means that we use cash to pay something, right? So we call it cash payments. So one major sources of the cash payments, where do we use the cash for? Like, what do we use the cash for, right? So the major activity that we pay by cash is the operating activities, right? For example, the manufacturing activities and the selling and administrative activities, right? Because we need to pay the workers, pay the administrators, right? So this is the first part of the cash payments that we are going to talk about. So let's say the manager told us that the firm pays 60% of the manufacturing costs in the months incurred. So this means that, let's say, in January, we expect to have $1,000 as the manufacturing cost. And usually it will first be billed as accounts payable, right? And we are going to pay 60% of them in cash to our, let's say, material suppliers, to our laborers, right, in cash in this month. And the rest, so the rest is the rest of the 40%, right? So the rest of the 40% will be paid in the following month. And other than the manufacturing costs, the firm will pay the operating expenses, meaning the S&A expenses, pay all of them in the months that the expenses are incurred. And other than that, we know that the firm has some depreciation costs. So this is something that we need to pay attention to. Okay, so whenever we record the depreciation, is there any cash involved in the depreciation? right? So if we have this asset, okay, and after 1 year, right, we need to record the depreciation for this asset. So is there any cash transactions related to the depreciation report? No, right? So once we know that some depreciation included in, let's say, either operating expenses or manufacturing costs, we need to take it out, okay? Because here we are dealing with the cash payments. So because the depreciation has nothing to do with the cash inflow or outflow, we need to take the depreciation amount out from any expenses that is contained in. Right? For example, here we have depreciation included in the operating expenses in the S&A. Right? So when we calculate the cash payments, we need to take this 1,600 out from the S&A. And I will show you later. So this is how the firm pays their manufacturing costs as well as the S&A costs. Right? So now I'm going to use this table to summarize the expenses for the costs for the manufacturing costs and the S&A costs. So here we are not dealing with the payments yet, right? So this is just to calculate what you should pay, okay? So this column in orange is the total manufacturing costs expected to be incurred for this firm in each month, okay? And this column summarizes the expected S&A costs for each month. So for the manufacturing costs, we know that it contains DM, DL, and overhead. Right? Suppose we are in this absorption costing. Okay. So we just need to sum all those expected sales from our previous budgets. Right? For example, for the direct material costs, these are actually from the direct material budget. Okay, so if you go back, right, to the direct material budget, okay, so these numbers are here. Right? So because here I'm going to calculate the total manufacturing costs, right, the total expected manufacturing costs that the firm should pay for each month, right? So I need to sum up all the expected components of the manufacturing costs, right? So I need to drag the numbers from the DM, DL, and overhead budgets that we made last class, right? So that's the DM, and the DL numbers are from where? The DL budget, right? So if you go back to the DL budget, right? So the numbers are from there, right? So did you see the connection here, right? And the overhead costs are from the overhead budgets, right? So if we sum up all the three components for each month, we can come up with the expected total manufacturing costs for each month. Okay, are you guys following me? Right, so today's class is a little bit challenging, right? I told you. So you need to follow me all the time. So that's the first column. Right? The purpose is to calculate the total expected manufacturing costs for each month in the budget period. And now let's look at the budgeted S&A. Okay, so from the S&A budgets, we know that for each month we expect to incur these S&A costs, right? Okay, let me go back. Okay, but because from the information given, we know that in the S&A costs, we have 1,600 as depreciation, right? And depreciation, as we already discussed, has nothing to do with cash inflow or outflow, right? But here we are dealing with the cash. So we need to take the depreciation amount from the total expense of the S&A, right? So here, what I did is to take the 1,600 depreciation amount from each month, right? So here I did this subtraction, right? So here the clicker question is, which of the following expenses do not appear in a cash budget? It should be the depreciation expense that I just talked about, right? Because as I said, the depreciation has nothing to do with cash, right? So it should not appear in the cash budget, right? Any questions related to this? So for the marketing expense, as long as you pay the expense by cash, it should be included in the cash budget.
So why we in cash flow statement we reimburse the depreciation? If depreciation has nothing to do with cash,
Yes.
then why in the cash flow statement we reimburse the depreciation amount or the depreciated
Okay,
amount?
so here, let's look at this setup. So we are not reimbursing the cash. What we do is that, so let's look at this one, right? So previously, when we come up with the S&A budget, right, we expect how much should be incurred for the S&A for the next period, right? So that is where these numbers come from. But now, according to our story, we say that in this S&A estimation, we have 1,600 as the depreciation. Right? So first of all, these S&A amounts already include the depreciation, but now we are dealing with the cash, right? So we need to take that part out from the total amount. So we are not reimbursing. The depreciation is still depreciation, but here we need to take that part out to consider the cash part. Yes.
So in the operating expense, what other, so depreciation is a part of it, what about other accounts, what are the other accounts that are a part of the operating expense?
So the main part is the S&A, like you could have other expenses, but the S&A is the major
So
part.
S&A and then depreciation, they.
So let's say in the selling expense, right? So maybe you are using, let's say some equipment to facilitate the sales, right? So maybe those equipment will have some depreciation, right? So that could be one source of this depreciation. But here the main idea is that we need to exclude the depreciation because it's not related to cash.
Where do you find the interest expense?
Interest expense, yeah, I'm going to talk about it. So here, so the expenses that I summarized here are actually the expenses or costs related with the manufacturing and the operating, right? So we also have other activities, for example, the finance activity, investment activity, and other activities, right? So we're going to talk about those activities separately, but here it's all about the operation activities, okay? It means that the activities related to the manufacturing and also the selling and administration. So here, so I think we are good with this, right? So now we come to the real part of the cash payments. So this column here in orange basically just lists the manufacturing costs that we calculated before, right? So in January we expect to incur $46,680, right, as the manufacturing cost, which is all from here, right? So that's what we calculated in this table. And also we are going to, we expect to have the S&A cost, right? Which is calculated here, excluding the depreciation. All right. So that's the two components that we need to pay. And according to the manager, right, she said, or he said, every month we need to pay 60% of the manufacturing costs incurred in this month and pay the rest for the next month, right? So it means that in January we need to pay 60% of January's revenue, January's manufacturing costs, right? So this is the cash payments for this month, right? So January, right, we need to pay 60% of January's expected manufacturing costs. And in January, we need to pay 40% of December's manufacturing costs, right? So this element, right, we need to pay for December's 40%, right? And December's manufacturing costs will be given, right? 52,000, right? So in January, the two components, right? The one that you pay for this month's costs and the one you pay for the previous month's costs. But you pay in this month. Okay, is this clear? Right? It's similar to the previous one, but here we are dealing with the cash payments. And previously, we are talking about the two components from the cash receipts, right? But here we are talking about you pay someone else. So that is the two components of the cash payments for manufacturing costs, right? But we also need to pay all of the operating costs, S&A costs in this month, right? So we just need to pay all of them, right? So it's in here. And if we sum these three up, right? So this is the total payments that you need to pay for, you expect to pay in January, okay? Are we clear about this? Right, so the first, this one, so when you do the summation, right, you only sum up this, and this, right? So the first goal is just you list the manufacturing costs you expect to incur for each month. Right, so following this logic, would you please calculate the different components, right, for February and March? And I will invite Isana. Yeah, later. 1 minute later to answer this question. If you need the data, just tell me to go back. So Isana, yeah, your turn. So let's talk about the February, right?
So in the first section, 18,600.
So this part is that in February you need to clear up your debt from the previous month, right? So you need to pay the rest of the 40% for the January's bill, right? So in January, for the manufacturing costs, we have this 46,680, right? So you pay the rest of the 40% in February, right? And also in February, you need to pay your current
32,500.
right, because that is the 60% of February's bill for the manufacturing cost, right? So in February, our expected manufacturing cost is 54,220, right? So 60% of this is this amount. And we are going to pay the full amount of the operating expenses, right, the S&A. So what should be the total expected payments in February?
74,500.
So that is the sum of these three numbers, right? Okay, that's a good job. What about March? I'm going to ask, Peg did you just read
I'm on
it?
the slides, yes. I'm just going over the slides.
Do you want to ask someone to help you?
Anybody willing to offer?
You take the previous month's manufacturing cost multiplied by the percentage of the revenue.
Yes. So did you hear that?
Take the last.
So could you please repeat?
Take the last month's, say it again? Manufacturing cost, and then you multiply it by the revenue.
Okay.
Okay.
Because we said, let's say this month, right? You are the supplier of the materials for me, right? So let's say in April, okay, and you bill me for some amount, right? And according to this, the information given by the manager, right? I need to pay you 60% of what you billed me in this month, right? And I will pay you the rest next month. So it means that each month you are going to receive 60% in cash of the bill that you bill me this month, right? And 40% for the previous month amount. Does that make sense? Right? So this is the story. So that is why in March, right, you are going to receive 40% of the previous month's manufacturing cost, which is February. Right? And then you are going to receive 60% of the manufacturing cost in March, right? And also we are going to pay full amount in March of the operating expenses incurred in March. Right? So the total expected payments in cash is the sum of these three numbers. Yes.
Is it always gonna be like that we're gonna have to pay debt from like the previous month for cash payment? Like, is there
That's
some-
why I said it depends, right? So the 60 and 40% is just the story in this example, but it differs across firms and across industry, right? So this is just a fake example that I gave, but it illustrates the idea here, right? Because usually when there is some accounts payable or receivable, right? We need some time to clear up the money that we owe or the money that we that people owe us, right? So there is always a time lag. So this is to consider this zigzag of receiving and paying, right? So this is the cash payments for the manufacturing costs and the operating costs. But as I said, there could be other cash payments, right? So David already mentioned this point, right? So besides the manufacturing activities and the selling and administrative activities, we may have other activities that require cash transactions. For example, we need to purchase capital expenditures, right? For example, the factory, the trucks. So the capital expenditure means that we purchase the assets that we are going to use in long term, and that could generate revenue, right? So for this kind of capital expenditures, we may need some cash transactions. And we also, so if you are a public firm, right, so sometimes we pay the stockholders in dividends, right? So the stock dividends could be one source of cash payments, and that is the finance activity, right? So that is related to the finance activity. And also, if you have some bonds outstanding, right, it means that you have bondholders that you owe to, right? So if you redeem the bonds, it means you pay back the bonds, right? So this also relates to the cash payments. And stock repurchase. So if you have some outstanding stocks and you want to repurchase them from the current stockholders, right? So sometimes this also involves the cash payment. So the last one, the principal and interest. So let's say if you made a loan from a bank, right? So you need to And sometimes the firm may have some cash policy. Let's say this firm, they want to, let's say the cash policy could be, I'm a firm and I want to make sure that each month I will have 30,000 cash, at least 30,000 cash at hand. The reason could be the cash is actually very flexible, right? Because it's liquid, right? So it gives us a lot of convenient, it's very convenient for the firm to do some activities, right? So sometimes the firm will establish some cash policies, right? To say this is the level of cash that we need to maintain for each month or each quarter. So if a firm has this kind of cash policy, it means that, let's say, when we make the cash budget, right, and we know, okay, for next quarter, we are going to have 20,000 cash at the end of the quarter. But the cash policy says that we need to have at least 30,000, right? So in that case, you may expect to make some, to borrow extra cash, right, to fill up the gap, to maintain the level of cash that is required by the cash policy. So these are the other elements that could impact on the cash level, right? So after we, so let's say this firm, they plan to buy some new equipment for 50,000. So this is the capital expenditure that we talked about, right? So this is cash payments for the capital expenditure, and they expect to pay the dividend of 5,000, and they are going to retire 20,000 of the bond. So these are cash payments related to the financing activity. Okay, and right. So this is the cash policy that the firm has. They say they want to keep 30,000 cash at all times to meet the cash needs. So based on this information, we can make the statement of cash flows. So let's look at the statement of cash flows budget. So first, let's look at the components of the cash flow statement. So first, we have the cash flows from the operating activities. Basically, it means the cash flow from the manufacturing procedures and the S&A procedures. And we have the cash flow from investing activities. So basically, this means the capital expenditure. Okay, and the cash flow from financing activities. For example, the redemption of the bonds, the repurchasing of the stocks, or the dividends payment. Right? So those are the financing activities. So these three are the components of the cash flow in this statement of cash flow. So after we take into account the three components of the cash flow, we can calculate the net change in cash. Right? And if we know the beginning balance of the cash, we can calculate the ending balance of the cash by using the net change. Okay, let's see how we can make this based on the information we have. So first, the cash flows from the operating activities. So first we have the cash receipts that we, okay, I'm going to slow down here because people are getting confused. So the cash inflow or cash receipts from the operating activities is generated from the cash receipts budget that we just made. But here, the statement of cash flow is for the whole quarter, right? For January, February, and March, right? So here, we take the sum of the cash receipts for the 3 months to generate the total cash receipts, the total expected cash receipts for this quarter, okay? So if you want to validate this number, right, you can use your calculator and do the calculation. So the total expected cash receipts for this quarter is 285,840, right? Yes.
On the test, will we have to calculate that, or will that number be given to us?
Which one? The cash receipts?
Yeah, the total cash.
It's already, we just made this.
No, I'm saying, but on the test, will we have to go through this process to find it, or will it be given to us?
So I think in your homework, each question is independent. But in reality, it's all connected. And in the exam, I might just follow my template. So I might just give you the cash receipts and cash payments. And follow that, I need you to come up with the cash flow. So you need to use the previous information, right? So the information will just be connected. Yes. So this is where the cash receipts in the first part, right? Where this comes from. And the cash outflow or cash payments for this quarter, as you might expect, right? It's from the cash payments budget that we made. And we also need to take the sum of the three cash payments, right? For the 3 months. So the cash payments, the total expected cash payments for that quarter is this 211,854, right? So then, see, right, we have the cash receipts, which is the cash inflow, and we have the cash payments, which is the cash outflow, right? So I added a bracket. It means the negative part, right? The cash that has flowed that we paid, right? So the difference between the two is the net cash flow from this operating activities, right? From our manufacturing procedures as well as S&A, right? So the net cash flow from this operating activity is a positive number, right? And it's around 74,000. Yes.
So the bad debt is not included in there.
It's not, because when we calculate the cash receipts,
Yeah.
right, we already excluded the 1% bad debt. Yeah, so it's not, it's already considered. Okay, so for the cash flow from investing activities, we talked about that, right? So it's the purchase, it's about the capital expenditure, right? From the previous information, we know that they purchased some equipment for 50,000, right? So this is the cash payments. So the cash outflow is here, right? So we put a bracket 50,000. And for the financing activities, this firm paid the dividends for 5,000, right? According to the previous slide. And they retired the bonds of 20,000. Right? So these are still cash outflow, right? So we use the negative sign here. So it means that in total, our cash outflow from the financing activities is 25,000. Right. So now that we have the three components, right? The cash flow from operating activities, the cash flow from the investing activities, and from the financing activities. So now, can someone tell us how this net cash, net change in cash is calculated? So how come we have a negative 1,014? Yes.
They added the net from operating activities
Yeah, so
investing.
we
financing.
add the 73,986. Right, so this is the cash inflow from the operating activity. And you add that with the cash outflow of 50,000. Basically, you subtract this number. And then you subtract 25,000, right? So that will give you a negative 1,014, right? So that's the net change in the cash flow. Does that make sense? Yeah.
I just want to ask a question.
Mhm.
It's outside of that
Yes.
slide, but like if the company do have like an investment portfolio and we bought some stocks in the different companies.
That belongs to the financing activity.
Finance.
Yes. So let's say if they gain some profits, right, in terms of cash from their investment in portfolios or whatever, or stock issue, down to the financing activity as a cash inflow. Yeah, because in this example that I gave, let's say they only have cash outflow, right? But in reality, they have multiple activities containing both cash inflow and outflow. Right? But here, let's just stick to this very simple example. Okay? So they will have a negative cash change. So if, let's say, at the beginning of the quarter, they have 30,000 cash at hand. Then it means that we expect to have 1,014 short of 30,000 cash at the end of the quarter, right? So this is the statement of cash flow, right? So we consider the cash flow from the three activities, right? The operating activity, investment activity, and finance activity, and come up with the net change, right? And we add the net change to the beginning balance to come up with the expected ending balance of the cash. But as managers or managerial accountants, we need to think about the implications of different numbers, right? So here we can see that we have a positive, or we have a positive cash, not positive, just cash inflow, right? We have a net cash inflow from the operating activities. And generally, this means this is a good sign, right? So it means that at least we are collecting more cash than we pay to finance our operating, let's say, manufacturing procedures or the S&A, right? So generally, it's a good sign. But what if it's a negative, right? It doesn't. So a lot of the time, people are worried about getting a negative cash flow or a net cash outflow. But at those times, what managers need to do is really to investigate what happened there, right? For example, if this is a negative number, then let's say after the managers investigate, right? So they found, it's mainly because the bad debt is too much, right? Our customers are just not paying us. So if that's the case, then we could take corrective actions by screening the type of customers that we deal with, right? So the main thing is that we need to figure out what does those numbers tell us, right? And to take corresponding actions to make the business operate in a healthy manner. And let's look at the cash flow from the investing activities. So for the investing activities, generally speaking, most of the time this is a negative number because the investment activities mean that you invest in assets that can generate long-term revenue, right? So most of the time, it should be a negative number. But this is this a good news or bad news? Could be a good news, right? It means that the firms are investing for their future, right? So we should be able to interpret those numbers and knows what does the number mean, right? And for the financing activities, here we have a negative number, but also it doesn't mean it's a bad news because let's look at why it's a negative, right? It's because we pay the stockholders dividends and we retire some bonds, right? So it's very neutral. But let's say if the cash outflow is caused by, let's say, loss from your portfolio investment, right? If that's the case, then maybe the firm needs to be alert a little bit and think about the portfolio that they invest, right? So it depends on the situation. Yes.
I just had a question in terms of the cash flow for investment. Can that ever be positive? Like, let's say you trade in equipment and the value of your trade-in is greater than
Okay, if you
coming in.
consider that, the then, yeah.
then it can be.
But I haven't looked at that question. I'm not an expert in that. But yeah. Yeah. I think if someone knows more than me, you can enlighten me. I'm not an expert in this. Okay. But here the basic idea is that we need to think about, right, the implications of those numbers. And the other two, right, the budgets for the income statement and the balance sheet, I will just run through them real quick. So the basic idea is that we make the balance sheet as well as the income statement the way we make that we learn from the financial accounting, right? So the only difference is that all the numbers that we deal with are expected numbers, right? So that's the only difference. So let's say the budgets for income statement. So we have the sales, right? So the sales is actually the total expected sales from the sales budget, right? So if you want to go back, it should be the sum of the numbers that we came up with. And then if we have expectation for the cost of goods sold, right? So that goes here, and then we will have an expected gross profit, and then we can subtract the expected S&A, and then you do the following, right? So the only difference is that the numbers are expected numbers from the budget, right? So that's the budget income statement. And then the last one, the budget finance, balance sheet. Oh, I didn't put it here, but it's on your textbook, right? So the only difference is that all the numbers are your expected numbers. So now we still have 20 minutes, so I want you to open the Excel project, and let's do the cash budget, right? The cash receipts, the cash payments in the Excel. Okay, so let's go to the tab of the cash budget receipts. So today I want to finish the last 3 tabs. So this one is the cash receipts, adapted from the slides, right? So everything is the same there. So I want you to complete the cells in blue, okay? And just use the information you have at hand. And so I will walk you through the January, okay? So here, let's see, the following information is given, right? So in December of last year, we have 90,000 revenue. Right? Everything is the same from the slide. And the 75% of the accounts receivable can be collected in the months of sale, 24% in the following months, and 1% is bad debt, and we cannot collect it. So requirement number 7 is prepare this cash receipts budget based on the following, based on the above information and the sales budget that we just made from last time. Right. So the cash receipts of January is consisted of the cash receipts from the prior month and the current month. Right. So the prior month of January is December. Right. So we only care about the sale. And December's cash accounts receivable or revenue is 90,000, right? It's given here, 90,000, and we can collect 24% of it, right? 24%. So that's the amount that we can collect in cash in January, which is from December. And then we can collect 75% of January's revenue in January. Right? In January, we made how much we expect to make how much revenue. We need to go back to the sales budget. Okay? Look at what I do here. I go back to sales budget, and I take this number, right? Multiply by 60%. Right? So this is what I do here. Okay? And then the total cash receipts is the sum of this two. Okay? So now I'm going to invite
75%.
Yes, 75%. Sorry. Yes. Okay, I'm going to invite the people from the last row one by one. February. 80,000 is not January's revenue. No, you should go back to the sales budget. Or can someone else help? Or David, you can go and help. Oh, this something? Yeah.
Those numbers? Yeah. You know what else? On top of like for January, 80,000. So, yeah, you got your previous, January here. And then down here is the current, so 96 by what? Exactly. And then these are something, so it's. Same thing for March.
So I think, so David did a good job here, right? So honestly, I should add one column here so that we can put the expected sales amount here, right? So if we have that information, which is from the sales budget, okay, so we can calculate. So for the February, we collect 24% of January's expected sales, which is 24% of the 80,000. And then we collect 75% of February's sales, which is 96,000. Okay, so the total cash receipts is the sum of these two. And then we do the same thing for March, right? So that so you should be able to do this. And then for the next one, cash payment. And right, so the information is still the same as what's given in the slide, right? So we say for each month, the firm will pay 60% of the manufacturing costs incurred in this month, and then the rest will be paid in the following month. And then they will pay the full amount of the operating expenses in the months that they are incurred. And then we need to consider the depreciation. So here this table is almost the same as what has been provided, right? So I will walk you through the manufacturing costs and the operating costs in January. So the direct material cost, the expected direct material cost is from the direct material budget, right? So this equals to the direct material budget we calculated in January. And the direct labor is from the direct labor budget we created. Okay, we take the number for January. And then the overhead is from the overhead budget, right? And in January we take the January. And then the total manufacturing cost expected is the sum of these three components.
Professor,
Yes.
we didn't do that one in the class, the direct labor.
So if you didn't do this DM, DL overhead, you should first do this, right? So that you can have, so that the number can be quoted. So if you haven't done that, you should do it. And since you don't have time here for you to do that, I will just illustrate. Okay, and for the operating expenses, right, so the SNA, so the expected SNA from January is from the budget that we, okay. But it should be this number, right, so I will just quote. And that's the depreciation, it's 16,000. So it should be this number. Let me finish this. So I think I will just let you do this after class, because if we didn't complete the previous budget, it's not possible for us to do this. But the basic idea is there, right? So we need to have the data from the previous budget that we made, and then do the calculation. And following the same logic, right, you should be able to complete the cash payments budget, which is the same from the slide. And after that, based on the cash receipts and cash payments, as well as other information, right, you should be able to complete the statement of cash flow budget. So this will be your own work, and as I mentioned, right, so it will show up in your exam in some way, right? So you should be able to complete this. And I will upload the answers, the solutions tonight, so that you can play with the whole thing. But the whole idea here is that you need to be able to do this by yourself, right? And you guys already did the exam too, and you should know the kind of skill that I expect